What's up, money lovers? This is Vinny from the Investment Club. Welcome back. If you're brand new to investing or you just need some help getting started, then you're in the right place. Now, this will be a multi-part series, so if you enjoy the video, please feel free to subscribe below and stay tuned because you don't want to miss this. So, investing in stocks can be a very powerful tool to help you build wealth. While you're busy working and living your life, you can be putting your money to work for you. Look at every dollar you make as a little employee that you send out to make you money. Now, before you think about buying stocks, you need to ask yourself some questions. What do you expect to get out of investing in stocks? What kind of investor are you? Are you a long-term investor or a short-term investor? What's your time horizon? Are you looking to make a quick buck, or are you prepared to possibly buy and hold the stock for many years before you will see profits? How will you react if you wake up one day and a company you bought is down 50% from the price that you bought it at? Are you going to panic and sell? You need to think about these things before you start, and it will save you lots of headaches and financial losses down the road. Perhaps most importantly, you should write out a mission statement on what your goal is. What is your end goal? Where do you want to be in 5, 10, 30 years? And why do you want to be there? What will you invest in and why? Are you willing to put the time in to invest the right way, doing the research, or just follow whatever headlines you see in the news, or that text from your friend who found the next penny stock Amazon and you need to buy it ASAP? There are many ways to approach investing, which we'll get to in the next episodes. If you prefer a passive investing approach that will let you sleep easy at night and you don't have to do tons of research into individual companies, maybe that's not your thing, then there are options. There are index funds. You can invest in dividend stocks that produce steady income, or growth stocks that carry higher risk but higher potential reward. You can invest in a combination of all three. That's what I like to do. Now, we'll get to all this, but for now, let's just talk about stocks. So when you buy a stock, you're essentially buying a piece of that company, which is pretty cool. If I buy one share of Apple, I can say that I own part of the global conglomerate known as Apple. A very modest portion of it, at least. Now, businesses sell stocks to raise money in order to fund their operations. Now, as far as dividends are concerned, many companies pay a dividend, generally companies that have been around a long time. A dividend is a distribution of profits or money to shareholders, and it's typically paid on a quarterly basis, but there are exceptions. So while some companies are different, generally you can expect to receive a dividend or a cash payment from a company that pays a dividend 4 times annually, about every 3 months. So if you own 100 shares of company A, which pays a dividend of $4, you will get $400 annually, because you have 100 shares times $4 a share, $400 annually, or $100 every 3 months just for holding a piece of that company. This is nice because no matter whether the stock price itself has gone up or down that year, you can rely on getting consistent dividend payments, which you can then use to do anything you want. You can use them to pay your bills. You can reinvest them into the company to make even more money, or you can spend it on whatever you like. Next up, we have mutual funds. Now, these are large groupings of stocks that are typically professionally managed. If you prefer a passive investing approach or just feel safer having a professional in control of your investments, then this can be a good option. You can buy a mutual fund that is, say, $100 a share, but it encompasses hundreds of different companies. Instead of spending $100 on one share of one company, you can spend $100 and get a piece of hundreds of different companies. This is a great way to diversify. Now, some downsides to mutual funds are that they generally charge management expenses or fees, which take away from your profits. For example, you may pay a professional 4% annually to own their mutual fund. So no matter whether the fund actually makes money that year or loses money, you have to pay that 4% fee. So let's say the fund made 10% in that year, but you're only going to take home 6% because you have to subtract the 4% management fee that they charge. If the company lost 10% that year, you really lose 14% because you're paying that management fee, no matter how the fund performs. The second downside to mutual funds is that they tend not to be able to outperform the market for very long, if at all. Which brings us to our next investment, index funds. Now, I generally prefer to invest in index funds over mutual funds for 2 main reasons. They tend to outperform mutual funds over the long run, and they charge lower management fees. To me, this is a no-brainer choosing between mutual funds and index funds. Say you buy an index fund like VTSAX, which is the ticker for Vanguard's Total Stock Market Index Fund, which I personally own. When you buy VTSAX, you'll be investing in a piece of every company listed in the US stock market. Now, this is a great way to get started and help you build up a strong base for your portfolio before you invest in individual stocks, but that is ultimately for you to decide. If you look, there are many different options, but index funds generally track their market index. So while VTSAX tracks the performance of the entire market, a fund like SPY tracks the performance of just the S&P 500, the 500 companies that make up the S&P. So whatever returns the stock market as a whole gets that year is the returns you will get by owning these types of index funds. Index funds are generally pillars of retirement accounts as they provide the least amount of risk over a long period, as opposed to owning an individual company in which anything can happen on any given day. Now, that being said, index funds are volatile as the stock market is very volatile from year to year. Some years you will lose money, but over the long run, you're going to make a lot more money than you lose. So where do you get started? There are more options now than ever to help you get started investing. You can do it independently through a bank, a brokerage, some popular brokerages, including Fidelity, Robinhood, Vanguard, you've probably heard of. Those are all good options. You probably have retirement accounts like a 401k through your job that you can contribute some of your income to. You could also set up your own IRA or a Roth IRA and contribute to it independently, or you can speak with a financial advisor to determine what's best for you. Now, many accounts require no minimum balance, so you can start investing with as little as $1. I mostly use Fidelity because I think that it's very straightforward and they charge no commission fees, which even if they're small, let's say a brokerage charges you $5 commission fees per trade. This adds up a lot over time. With each time you purchase a stock and sell a stock, whether it's 1 share or 100 shares, these fees really start to eat into your profits. So I'd like to avoid paying commissions. Now, the most important thing is to get started as soon as possible. That is, once you've established your goals and have a solid understanding. That way your money starts to compound. Compounding is when your money starts to multiply, and the most important factor for compounding is time. The sooner you start, the more money you will have in the long run. So stick around for the next video where I'm going to talk more about the specific types of investments and help you determine what type of investor you are and where you should start. This is Vinny from the Investment Club, and I'll see you next time.